All right. Here we are, another morning, ready to watch the morning bell, watch the ponies take off out of the gate. So we've got 4 minutes until the market takes off. My name is Lan Turner. I am, just to give you a little information about me, I am former instructor of the Chicago Mercantile Exchange and the Board of Trade Education Centers, currently an instructor at finance at Utah Tech University. And in the university, we teach classes on how to trade the markets. And so we're focusing on day trading, doing a little bit of day trading, learning a little bit about the markets and how they work and function, talking a little bit about the futures market, how it compares to the stock market. And so what we want to do is we're watching the stock indexes as they're being traded in the futures market. And we like the futures market for day trading, for short-term trading, because of the leverage. I mean, we get good leverage over here. So it takes a small amount of money to make a large amount of money. Of course, the knife cuts both ways. So if you can make a large amount of money with a small amount of money, you can also lose a large amount of money with a small amount of money. So you have to be careful. And that's what this is all about. So we're all about learning about how to manage our risk. So it's risk management, and we're trading strategies. All right. So we're not investing over here. This is not in a long-term investment. We're not going to come in and buy corn or wheat or soybeans and hold it for 6 years and see if corn or wheat or soybeans goes up over the next 6 years. This is trading. All right. There's a difference between investing and trading. And so over here, we are going to get in, make a profit, get out. If we get in and we start to lose money, we immediately get out. If the market doesn't decisively move in our favor after we make the decision to get in, then we just get out. And there's no reason to take a big loss, because we're not going to be what we call bag holders, people who hang on to a position for a long period of time hoping that it comes back. That's called bag holding. We don't want to do that. All right. So we want to just decisively get in at a specific setup or a trigger, and we get in and we get out once we've made some money. So that's how it works. So right now the markets are starting to take off. You can see this is pre-market session. So what's happening is a lot of people who are in the markets probably short because of that big drop right there. Let's bring the charts up full screen here. There we go. You can see the market starting to rally before the market opens. Market actually in the futures market opened yesterday at 3 o'clock in the afternoon. So it trades 23 hours a day, trades all night long. But for those people who only trade the stock market, they have an open at 7:30 my time Mountain, which is 9:30 out there in New York City. So these markets already opened us in Chicago because our exchanges are traded in Chicago, right? So we're out of the Chicago markets, and these markets are already open, so you can trade them. But New York, and we're looking specifically at the indexes. These are the stock indexes. So the stock indexes have an open time of 9:30 a.m. Eastern. And so what's happened is, because we've got they also have the pre-market session, right? The pre-market session is a little bit different for stocks traders. When you're trading in the stock market, the pre-market session is the hour and a half, 2 hours before the market opens. And they're only allowed to use limit orders. And so it's very restrictive type of trading. And so they can start using market orders and stop orders come 9:30 Eastern. And so what happens is you get a lot of people who are trading the pre-market session, but when the new bell rings, they want to be out of the market. Now, if you've sold and gone short, which is what's happened here, lots of short sellers selling the market down, they want to get out before the bell. And how do they do that? Well, they have to buy, because they were short. So they had sold. So now they have to buy to get out and take their profits. And that's what you're seeing here. You're seeing just before the market rings the bell, they're buy. That's why the market started to rally, because they're getting out of their short positions, getting ready for the opening bell. So the opening bell's coming up here in right now. Bang, there it goes. The ponies have opened the gates, and let's see which way direct. Oh my gosh, look at the Russell. Over here, Cousin Russell just dropped like a rock, just exploded to the downside. Now he's coming back. We're going to watch the NASDAQ. The NASDAQ, remember, is a little bit tech heavy. The NASDAQ 100 is the 100 stocks, biggest stocks on the NASDAQ exchange. So primarily all your tech stocks. And then the Dow, that's the Dow 30 industrials. And then we have the S&P 500. So the 500 biggest stocks in the stock market. And that has some crossover between the NASDAQ and the New York Stock Exchange and the AMEX. So you have some stocks that kind of cross over in there. And then we have the Russell 2000. Russell 2000 is 2,000 small cap stocks. So it's a small. We call him Cousin Russell down there because he's not got any overlap between the S&P, the Dow, and the NASDAQ. And he kind of does his own little thing down there. Usually these markets do what I call porpoising, meaning that they all kind of move together. They all, like, you ever watched dolphins in a wave? So dolphins kind of all do the same thing. They're all kind of porpoising at the same time. And that's what these markets do. They all have a tendency to do the same thing as they rally and fall basically at the same time. The thing that you'll notice is that oftentimes you'll have a leader. You'll have one that takes off and goes first, and then the others will kind of trail up and follow. So if you watch the leaders, you can then trade the laggers. The ones that are slow to move, they're generally the ones that'll come and they'll follow, and you can catch on to those and ride those up. So right now we're seeing that. Okay, we're seeing the S&P, the Dow, and the Russell are all taking off and going long. The NASDAQ is a little bit slow to move. So if you wanted to, you could get into the NASDAQ right now and anticipate that it's going to continue to rise with the rest of the markets, because it's a little bit slow right now to lag to the upside. You also have to remember, though, that the NASDAQ is a larger market. So it doesn't have to move as far to make as much money or to be as big a percentage move. So these others, S&P, Dow, Russell, they could take off and look like a big run. And the NASDAQ could be a smaller run, but it could be equal in percent size or equal in dollar size, equal amount of money. So you have to take that into consideration as well, too. And they also have to take that into consideration when you're setting up your trading tools. Now, we're in Track and Trade, and this is a live trading platform. It's not just a charting platform that, like you might see on the internet, of free charts. This is a true live trading platform designed for more of a professional level platform designed for active traders. And so it's got all kinds of capabilities in it that most software doesn't have, that's going to help you enhance your trading, be able to do things more quickly, react to the markets more quickly. The software is going to trade for you in many circumstances. You can click just one button and it'll start taking over and it'll do the trading for you. The computer can execute trades for you way faster, way more accurate, and way more precision than you can yourself. It doesn't get tired of watching the market. It doesn't, look away. It doesn't have to go to the bathroom. It can sit here and it can monitor the market for you. And when you're ready, you push a button and then it'll start monitoring the market and it'll take those trades for you. There's varying levels of how that works. You have some, what I call the manual method, the semi-automatic method, and the fully automatic method. So we do kind of a combination of all three. We have the autopilot here, which will do a full trading strategy. You just tell it everything you want it to do, and you don't have to program. You don't have to write actual computer code. You just got to go in and tell it what you want it to do, and you hit start trading, and the autopilot will actually trade for you. We'll get into that a little bit later, but that's one of the capabilities of Track and Trade. When we're trading like this, I like the semi-automatic method, which is kind of these QOCO buttons down here, where I can watch the market. When it gets to a specific level, I just click one button, drop the order on the screen, and then the computer takes over and trades it for me. Or you can just have the manual method, where you can use these buttons right up here, where you get the stop, the limit, the buy market, the sell market. These buttons are just kind of your manual settings. And then you have the quick QOCO buttons, which are all the semi-automatic methods. And then you have the autopilot, which is the fully automated system. So there's a little bit to learn there. A lot of times when people are just getting started, new learning how to trade, you have two learning curves. You have the learning curve that you have to be, you have to learn how to trade. First of all, you have to learn count, measure, setup, trigger, follow through. You have to learn all the strategies. You have to learn what's going to, when to get into the market, when to get out of the market. You have to learn, what kind of orders to use. Are you going to use a market order? Are you going to use a stop order? Are you going to use a limit order? You got to use a trailing stop. What kind of things are you going to do? What are these different tools that are available to you to trade? So you have to learn all that. And then you have to also learn the software. Now you have to learn the software, and you have to learn how the software handles OCO orders, or one cancels other, or one triggers other orders. And you have to learn what a market order is, how to click a market order, how to use a stop order, how to put a stop order into the software. So you have two levels of learning curve that you have to deal with. And so to do that, and then of course, we've got all kinds of technical analysis tools. So we've got indicators, we've got all kinds of things that you can use. You have to learn how to turn those on. You have to learn what they are. You have trend line tools. You can draw trend lines on your chart. You can draw all kinds of things like head and shoulders and wedges and triangles and patterns, and you have to learn all those. And there's just a lot to learn. So in the beginning, don't feel like you're overwhelmed too much. You're going to be overwhelmed, but you don't have to learn everything at once. You can just take it slow and start off slow. And that's why I'm here to help you, to kind of help you identify just some entry strategies and to get off on the right foot. I want you to get off on the right foot and not get overwhelmed with too many things. You go out and watch all the YouTubes, and you can watch 10,000 channels of 10,000 different ways of doing 10,000 different things in the markets, and you can get overwhelmed by people saying, "Look, I made $8,000 in 30 seconds." Is that possible? Yeah, it's possible. You can do that. Would I recommend you take those types of risks? No, not right now. Wait until you're a little bit more savvy in the markets. You learned how to do some of these things that we just talked about. And then you can take some bigger risks, and you can do some of that stuff and make some bigger money. But in the meantime, we want to take small risks so that if we're wrong, we just take small losses. We don't want to blow our account up trying to make $8,000 in 20 seconds like that guy over on YouTube, right? We don't want to be that guy. We want to be the guy that's just kind of very careful, very cautious. We want to come in and we want to watch the markets. We don't want to be jumping in and out all the time. We don't want to overtrade. We only want to take 3 or 4 trades, and that's all we want to take. And then we want to get our account green. We want to show some profit. We want to show some consistency, and then stop trading. I oftentimes tell people, you go to Las Vegas, and oftentimes when people go to Las Vegas, they'll say, okay, I'm going to put $500 in my pocket, or $300 or $1,000, whatever your budget is. So I'm going to put $500 in my pocket. I'm going to go down and start gambling. And then you're like, okay, great, wonderful. I'm going to stop gambling when I lose that $500. I promise, honey, I'm going to stop gambling when I lose that $500. And then what do? You stop gambling when you lose that $500. Now, it doesn't matter. You might have been up $5,000, right? You went to the blackjack table and you played and played and played, and you got up $5,000. But then you walk back to the hotel room with your tail between your legs, and you tell your wife, yeah, I stopped when I lost $500 because that's what I told you I was going to do. Well, why didn't you stop when you were at $5,000? Well, because you've never been trained to do that. The exchanges, Freudian slip. The casino doesn't train you to take your money when you're ahead. They train you to teach you, hey, when you lose $500, that's your budget. Stop gambling. All right, stop gambling. So that's what you do. It doesn't matter that you made $5,000. You never set a goal to stop gambling when you made a certain dollar amount. You just set a goal to stop when you lost a certain dollar amount. So you traded or you gambled until you met your goal, which was to lose $500. And that's what the casinos want you to do. So I'm here to retrain you and make you think about things from a different point of view. We want to stop trading when we make a certain amount of money. Okay. Now, yes, we need to have that loss goal as well. We need to say, look, if I lose a certain dollar amount, I need to stop trading too. And then we want to come back at another time when we've settled our mind. Now, a lot of people will come back the next day, which is fine. You can wait the whole next day and go off and do something else and come back later. I like to come back at the top of the hour. So let's say we traded and we lost a little bit of money. Well, I'll come back. I'll look at the clock and say, well, I got half an hour, or I've got 45 minutes until the top of the hour. I'll go do something else and then come back at the top of the hour, because it seems that markets have a tendency to trend nicely starting around the top of the hour. And then they get kind of quiet and get tired towards the end of the hour. So if you're trading and you lose a little bit of money, walk away, come back at the top of the hour and try again. So, you don't have to wait until the next day to trade. You can come back at the top of the hour. Now, that's kind of the indexes are kind of like that. If you're over in the stock market and doing a little day trading in the stock market, you might want to wait and come back the next day, because it does get tired in the afternoon and doesn't really have these rejuvenating moves in individual stocks oftentimes in the afternoons. So you have to wait until the next day to get kind of a big trend. But in the indexes, we'll oftentimes get at the top of the hour, we'll get some of these moves because it's a conglomerate of stocks, right? It's a whole bunch of stocks together. And so some stocks can move, or a big company will come in, a big bank or brokerage firm will come in, and they'll do their buying in the afternoon at the top of the hour. And that's what causes these markets to move. So you can, if you have a bad event or a bad experience, at 7:30 at 8 o'clock in the morning, well, come back at 10 o'clock and try trading again at 10 o'clock and at least recover maybe some of what you lost, or recover your losses. And I like to do that. I like to work towards recovery. A lot of traders will tell you not to trade for recovery, but I like to. That's Again, I'm not here to tell you how to trade. I'm just showing you how I trade, and then you can decide if that's what you want. All right, look at the NASDAQ. This thing is just tanking. So we first started to take right off out of the gate thinking, hey, this is going to be a good bullish market today. And it just ran up a little bit, and then it flushed like a toilet. What in the heck's going on? Why is the market not being decisive in one direction or the other? This is actually very common. This happens a lot in these markets. What you'll notice is the market has a tendency to rally up and then turn and flush back down. And what it's doing is it's going up, and we call it the sweep. They're sweeping out all the stops and all the traders that wanted to go long, and then it goes down and takes out all their stops to the downside. So it's sweeping everybody out. What happens is in the first thing in the morning, you oftentimes get these sweep motions, these little bounces back and forth. And then the market will become decisive and a little bit more decisive and start to trend and start to move. So although it's fun to watch this morning bell, and it's kind of like going to the horse races and watching the ponies take off and burst out of the gate and run down the fairway, you know, it's oftentimes not the best time to be trading. So it's a little bit too volatile. And so we just kind of sit and wait and wait for the market to decide what it wants to do. And then we can start to trade a little bit, let it calm down a little bit. But what we're looking for is we're looking for a continuation of a trend. So if you start to feel FOMO, fear of missing out, if you start to feel FOMO, that's a time where you can start looking to get into a market, because you want to wait for a market to start to move. You want it to make that move first, and then once it actually does make the move, you want to try and get in on that move. So the way we get in is we have a minor pullback, what we call a micro pullback, and the micro pullback is generally where you'd get into the market. So for example, this market is coming down, and we're using what we call Heikin-Ashi bars. All right, so these are Heikin-Ashi bars, and you can turn those on, and I'm going to show you how to turn those on here in a minute, because we had that question in class last night. We were teaching a live class at the university last night, and somebody asked me how to turn on Heikin-Ashi, and I was going to show them in class, and I forgot, so I'm going to show you here today. Track and Trade has kind of a funny way of turning on Heikin-Ashi, because it's not an actual different kind of price bar. So if you right-click on a chart, for example, and you come in and you say price bars, you got open, high, low, close, you got high, low, close, you got close, open, candles, and none. Well, candles are already turned on, and Heikin-Ashi is kind of a form of candlesticks. So rather than sticking it in here and saying the candles and Heikin-Ashi candles, they went and made it part of the settings, the chart settings. So you click, you have to turn on the candles first. So make sure those are turned on. And the way you do that is you right click on the chart. It gives you the menu. You slide down to price bars, make sure you're on candle. Once you're on candle, now you have to right click on the chart and go down to chart preferences. So you go to chart preferences, and it opens up the preferences over here in the control panel, and it's right there. You can see it's right there at the top. It says price bar type. In here it says candlestick, but then it says Heikin-Ashi candlestick, because Heikin-Ashi is a form of candlestick. So it's just a filter or a feature that you can add to your candlestick chart, and it's over here in the control panel settings. Now, Track and Trade, just like any good Windows program, has the ability to customize your bars up here. So you can make these button bars look like whatever you want. You'll notice mine are a little bit different than how it comes out of the box. I like to have, I like to have a duplicate of sometimes, like you'll see my trend line is in here twice and my arrow's in here twice. And the reason I do that is because sometimes I'm working on this side of the chart and I just want to come real easy and grab my line tool. Sometimes I'm working over here on this side of the chart and I want to just come and easily grab my line tool. I don't want to have to be working on this side of the chart and go all the way over here, grab my line tool all the way back. It's just kind of, saves time. And so when you're trading, you want things to be convenient for you. So you can customize these however you want. You'll notice I have a little HA up here in mine. You probably don't have that in yours. So the way you get that in there is you just right click on the little handle. So in a Windows program, you have little handles on your bars. You right click on them and you have a customized toolbar. It's basically the same in almost any Windows program. So then you have a available icon, so things that you can put into your icon bar, and then things that are in your icon bar. So then you just move one that you want, you just click on it over here and say add it to over here, and it adds it up there in the bar. And then you can move it up and down in the list where you want it in the lineup. So that's just a quick way of putting a little shortcut for Heikin-Ashi. And if you click the Heikin-Ashi bar, it turns Heikin-Ashi on and off. It's still got candlesticks, but that's your Heikin-Ashi feature. So you can turn Heikin-Ashi on and off just by clicking that button, and away you go. All right, so you can have Heikin-Ashi bars. Heikin-Ashi bars are, again, they're kind of a hybrid of the of the of the of the candlestick charts, and they kind of have a smoothing component to them. And so what we look for is we look for a little bit different patterns, a little bit different setups in the Heikin-Ashi bars than what we do in a normal traditional candlestick. And so we're looking for flat tops and flat bottoms. We like flat bottoms to the upside and flat tops to the downside. We don't like these little topping tails popping out. So for example, right here, if we look at the NASDAQ, you'll notice that we have a lot of topping and bottoming tails right there. Well, that's showing indecision. The market doesn't know if it wants to go up. It's rejecting up. It's also rejecting down. So it's not decisive in its direction. It doesn't know what it wants to do. But once a market starts to get lots of flat tops, it's very decisive in the fact that this is a downtrend because those bars are all red, right? So we want to make sure and keep that into consideration, that we're looking at is a trend strong? If it is, it's got lots of, to the downside, it's got lots of flat tops, and then the bottoming tails come out the bottom. All right, and then if it's a strong trend to the upside, it's got lots of flat bottoms, and there's no bottoming tails. Once you start getting bottoming tails, that's starting to show weakness in the market, and you're probably going to get a reversal. So you can see in this case, this is exactly what happened. We had a flat bottom, flat bottom, flat bottom, and then we got the little pullback in here with topping and bottoming in red bars. And then it turned and started to rally once again, but it had bottoming tails and topping tails. So that was kind of an indecisive move to the upside, but then it got more decisive, and we got flat bottom, flat bottom, flat bottom. So up, 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 up. And then suddenly we got a little tail that popped out the bottom. So that's indecision. All right. So indecision, and then indecision, and then it turned and decided it didn't want to go up anymore. It rejected price, and then down it flashed. So down, then we had lots of flat bottoms, flat tops. So if you get a flat top bar with a tail after a reversal of green bars, that's a good signal saying that the market's going to reverse and probably go the other direction. Now we're looking for recurring price patterns. We're looking for opportunities for the market to give us an opportunity to get into a market, into a trend. But the first few minutes of the opening bell, we like to just come in and bracket this market now. So at this point, those people who have been in our class before know that we're going to come in and we're going to actually bracket this market. Let's get rid of all these lines and we'll redraw them. So we're going to come in here and we want to re-bracket the market. And I'm just going to draw some horizontal lines across the screen. And this is from the top of the trend to the bottom of the trend. And now the market has what we call a channel. Okay. So we're going to come in here, and I've got two monitors open, and on my other screen I got another set of charts over here that I'm watching. And these are the daily charts, and it's making, with all the things I got going on, it's slowing my computer down a little bit. So I'm going to close that one. Save changes. No. All right. So that should make my computer go a little faster with all of this YouTube live stuff and video and everything going on at the same time. It kind of slows things down on me. So I want a faster monitor. I don't want the delay that causes. So we'll try and speed things up here a little bit. All right. So now what we're looking at is we're looking at the bracket of the market. We got highs and lows. And now if the market breaks out of this channel, we'll know that the market has decided that it wants to be bullish, right? Or bearish. Bearish meaning that we got downtrend, bullish meaning that we got an uptrend. So at this point, I'm going to get rid of this line here. Actually, we'll just move it right up there to this previous level of support. So that's kind of what we call our support and resistance. All right, we got support and resistance. Support across the bottom, resistance across the top. Think of it as a floor and a ceiling. If the market breaks out of this channel, we can then anticipate or figure that the market is now bearish or bullish. And so in this case, the market is breaking out to the downside on the NASDAQ, which looks like it's the leader of the market. It's showing us that the market is weak and starting to fall. And you can see that the cousin Russell over here is doing something all on his own. He's starting to rally. So we can watch these markets, and where do we want to take a trade? Where do we want to get in? So at this point, the market's kind of calming down. It's not quite so wild and crazy. And so there's maybe some opportunities to get into the market. So on cousin Russell, we might want to take a short position if the market comes and starts to fall and reverse and come back down and give us what we call an A, B, C, D pattern. So we'd have a little A, B, C, and then we'd look for D. D would take us back down in a continuation of the downtrend. Now, of course, the market could just keep going and rallying and going back up. And then you wouldn't take the short position, right? You'd watch for the opportunity to get back into maybe a bullish position. And that's what you're really looking for. And that's how we trade. We just kind of watch these arrows from this. This tool here is a simple tool. It's just called the average true range. So if you get an arrow that points up, that's not necessarily a buy signal. It's just indicating that the market has changed from bearish to bullish. And so we're now back into a bull trend. Therefore, we would only look for long positions. Now, some people will use different tools for different ranges. Like I know David Duty likes to use the average true range, the exponential or the simple moving average of quantity 50 on his average true range, or on his moving average. If he gets a buy signal from the ATR that's below the 50 moving average, he won't go long. He'll only take short positions if it's below the 50 moving average. Use that as a filter. If it's above the 50 moving average, he'll only take long positions. Below the 50 moving average, he'll only take short positions. So that's another tool that you can use. But this is just a simple way of looking at the market and saying, look, this is a bullish market. We got green bars. It's above the average true range. We could take long positions. So we're only going to take long positions, indicating that we would want to get long. But look at the market. So we want to look at all the markets and figure, what are these markets doing? So now this would have been, actually, I should have put an order in there. This is our signal that I was just talking about. The problem is that it's above the average true range and it's an up arrow. So this is showing a little ABC pattern to the downside, but it took it got an up arrow. Oftentimes we don't like to see the up arrow. We wanted to see it come up, turn green, not break the average true range, and then drop once again. So by having it go up, break the average true range, give us an up arrow, went a little bit too far. So the strength of the reversal was a little bit too weak. So, but there's your signal right there for entry to take a short position. And look at that NASDAQ, just keeps right on going. And there was our entry opportunity on the NASDAQ. I mean, it's easy to see in hindsight, right? You come in and there's your little, I call them shelves. So the market was coming down lower. The definition of an uptrend is higher highs and higher lows. Definition of a downtrend is lower highs and lower lows. So as this market was coming down, it was making lower highs and lower lows. And then it stopped right here. And you can see it made a higher low. So there was one spot, and then here's a better one right there. See how it pulled all the way back to the green, and it was making lower highs and higher lows. That's called a pennant formation. And that's our favorite little pattern right there. It's a continuation of the trend. We anticipate the market falling out the bottom of that little pennant formation, where it's coming into what we call a decision point. So that's lower highs and higher lows into a pennant formation, and that gives you the opportunity to look for a continuation of the downtrend. So the market's coming down. We get the little pennant formation, and then we expect it to fall once again. And that right there is our buy point. Okay. So do you know it's going to do that? No, you don't know for sure. And in fact, look over there on the Russell, it failed. We were looking for that market to come down, right? And I said we should probably even take a short position on that. And we didn't, but had we, that would have been a failure. And now the market failed to the downside. It's turning and starting to rally once again. That's why we don't like to take those if we get the up arrow, because it's saying, hey, we've gone too bullish. You want to take a short position here, you're going against the bullish trend. So now the market's making another one going this direction. So now it's gone up with the green bars. Okay, so we're watching it. It's going up. And then we get the little pullback, the red bars, and now it's the first green candle to make a new high, and now it's going back up again. How high is it going to go? That's the name of the game. Nobody knows. So you be real careful. You hold tight to your chest in the beginning and anticipate that the market's going to go. So here's another little signal right here. This is a buy signal right here. I should have taken it, and I was talking, wasn't paying attention. And there's a buy signal right there. First candle to break a new high. As it broke that red bar, that would be your buy signal right there. So this market, we could actually get in anticipation of a continuation of the uptrend. The NASDAQ is kind of bottoming out here. It's making a little area of support. Don't get anxious. I mean, you're like, Lan, you haven't traded yet. Well, we got 7 hours of the day, trading day, and it's only the first 20 minutes. Like, Lan, you should have traded like 42 times by now. If you want to trade 42 times in the first 20 minutes, go ahead. I'm not telling you what to do. I'm trying to teach you a little bit of lesson here. Yeah, we've missed a couple of trades here because I was talking, but that's okay. We'll take some trades. There's plenty of opportunities. Don't get anxious. Don't get nervous. There's lots of opportunities coming along. We're still inside the daily channel. We haven't even left the daily channel yet. We don't even know if the market's bullish or bearish yet. It's still neutral inside of this high and low bar channel, right? Now it went bearish on the Nasdaq. Nasdaq did break out the low channel. The Russell's still inside the channel. The S&P still inside the channel. So we haven't even determined the direction of the market yet. It's still channeling sideways. Could we have taken some of these trades, these small little moves in here, and maybe scalped some money? Sure, we could have. All right, let's come and say hi to a few people. Let's see who's in the house. Who we got? Everybody go in and add your name and say hello or something. So we got your names in here so we can see who's here. We got Gary Thomas. Great to see you, Gary. We got Camille. Camille's made it into class today. Great to see you, Camille. We got Matt Baker. Matt was our big winner yesterday. Took some trades. I think you said on the Russell 2000, right? Actually, I don't know what market you did on. You said you were trading with the David Duty strategy from the Pitt News Magazine, and he's one of our trade mentors in Trade Mentors, David Duty. I'm trying to get him to come and do a live presentation with us here. Come and trade with us live here. David's one of my good buddies. I've known David almost since the very beginning of my trading career, and he and I started Trade Mentors together. Love David Duty. Lan, what are the contract costs? So Gee Whiz is asking a great question. Don't let me forget. I'll come back to you. We're going to say hi to everybody, and then we'll come back and I'll try and answer that question for you. Mark Peterson's in the house. Another buddy of mine. I love old Mark Peterson. I was at Mark Peterson's house. He lives out in Minnesota, and I'm in Utah, and I drove out and met up with Mark Peterson. He and I have been trading buddies for years and years and years and years, and I finally met him for the first time in person. So it's great to have Mark Peterson in the house. And then we've got Oliver. Oliver's here. Great to have you, Oliver. We got, there's another one from all Pitt News. I got it today. Way to go, Oliver. Glad to see you picked up Pitt News. I'll go show you a couple of articles I want you to read in the Pitt News magazine if you went and got it. It's a really good magazine. This is David Lundberg. Great to have you, David. We've got Steve High from Indiana. Nice to have you, Steve. Indiana. And then again, Matt saying that he made his money in the NQ, so he was trading the NASDAQ. That's the David Duty strategy, I think you were saying, and so that's what David likes to trade. And then Oliver, how I get the PDF from the Pitt News. I'll show you that in just a second. Let's jump over and we'll take a look at it here in a second. And then Keith, great to have you, Keith. And then we've got Kurt Schwartz. Nice to have you, Kurt. So everybody who's in the room wants to be shown on camera is on camera. So you're all now famous. All right. Thanks for coming and joining the class, and it's good to have you. I noticed a lot of you here from the St. George class, from the live class that we had last night. And we got one more class, live class for that in coming this Friday. And then we take a week break and we're back again. Oh my goodness. Look over here. Look at the Russell take off. What a runner. That was a beautiful setup to the reversal side, wasn't it? So we got the reversal, we got the little pullback. It's always great in hindsight, right? It's always easy in hindsight. So there you go, and there that market goes, taking off like a rocket ship. Nice move. So, we could maybe anticipate that the other markets have all started to run. Let's drop one in here, see if we can catch that rally on the NASDAQ, see if the NASDAQ wants to go up. All the other markets are going up, so maybe that'll pull the NASDAQ up. We'll see a rally on the NASDAQ. We could put an order in there real quick just to see. And to answer your question, where did it go? Who was asking that question? What are the contract costs? Gee Whiz come in here and said, what are the contract costs? So we're in the futures market. And so what we're doing is we're trading contracts, not shares. That's starting to fail. Doesn't look very good to me. I want to see it break a little stronger to the upside. It's being weak. That's not a good sign. So we're on margin, and there it's breaking lower. So good thing we didn't go long. Okay, delete that order. We'll wait and see what happens. Look at pull the other markets down. So the NASDAQ started to fall out of the bottom of that little pullback. We could have probably taken that little trend to the downside. We could have bracketed that. Said if it breaks up, we'll go long. If it breaks down, we'll go short. But after all these markets were starting to go up, I thought we might get a rally out of the NASDAQ. I wasn't anticipating that it would continue to fall. All right, we're getting a reversal here on the Dow as it's starting to fall. Another reversal here on the S&P as it's starting to fall. All right, we'll watch these for a minute and I'll talk to you about how much this costs. So you have to open up your account. You have to put some money into the account, and it's a margin account. And then when you put on one contract, they take or lock a little bit of money out of your contract, out of your account. So that's how much money it costs you to put on one trade. And so if you come into the key, you can see over here, we're day trading. So the day margin is, let's see, if I open this up a little bit, you can see I got it pinched down there. There we go. Between 6:30 a.m. to 3 o'clock p.m. it's $750. So to put on one contract is $750. If you want to put on two, of course, it doubles that. It's $1,500, right? So that's how it works. So you get one contract and you have to put up a performance bond of $750. And that's in the mini. Now, these are the minis. If you go down to the micros, it's only $100. If you go over to crude oil, it might be $2,000. If you go over to gold, it might be, $1,800. So you have different margin amounts for different markets. And so when you put your trade on, that's how much money they're going to hold or lock out of your account. You can still then trade with the rest of it in other markets, but they're going to lock that $750 up so that you're trading that one in this market. Now, if you, forgot what I was going to say about that. Lost my train of thought. I started looking at these markets. Okay, I wanted to point out the fact that I noticed that the market is coming down and bouncing off the VWAP. That's the volume weighted average price. So the volume weighted average price is it's an important number because everybody else thinks it's important, and that's why it's important. So a lot of people watch the volume weighted average price. It's the average price of the market influenced by volume. So volume is taken into consideration. So you can see it's just kind of going flat across the middle of the chart. Well, the fact that it's going flat across the middle of the chart means that the market's not really trending. It's just kind of a flat market. Now, these markets, because we have such good leverage, for $750, you could put that in there, and that's down here on the NASDAQ. If we'd have got in on that break of that yellow arrow, that'd have been up $680. That's a lot of money, especially for a $750 investment, right? So you put $750 in the market, and those 4 bars, you'd made $680. That's why I'm not anxious to jump in. I'm not like, I don't have to feel like, oh, I'm missing all these. Oh, why aren't you in the market? Because it doesn't have to move very far to make a lot of money. And all you have to do is just wait for the right setup and feel real confident about your position. Get in, let that market move, and you can, make a lot of money in a short period of time. So we want to be very cautious and very careful. This is, Mark keeps reminding me, he's like, you guys are, when we come and play these big markets, this is like the Indianapolis 500. He's like, wait a little while in the afternoon or go to a different market. Maybe you can ride the go-kart. He says, go ride the go-karts instead of the Indianapolis 500. But, this is the fun. These are the fun markets. We love them. We love to watch the indexes. And yeah, it's the Indianapolis 500, and we like to race big cars. So we could go watch some other markets that are a little bit slower, don't move as aggressively, and maybe, even Mark likes to recommend using a larger time frame, 2, 3 minutes, 5-minute time frames. So there's different ways of trading these markets. And there's lots of different ways of attacking the same thing. So you're going to have to find what works for you. I like the 1-minute chart on the indexes because I think that, what I like to see is a market decisively move in my favor once I decide to get in. I don't like a quiet market that just sits there for a little while and I have to wait for it to move. I want to get in and I want to have that market immediately move in my favor. If it doesn't, I don't have the patience to wait for it. And so I start doing stupid things while I'm waiting for it to move. So if it doesn't immediately move in my favor, I generally just get out because I don't want it to go against me. So let's see if we can't stop talking so much and see if we can't get a trade on. We've already been 30 minutes and we haven't made $1 million. What's wrong with us? I mean, my goodness sakes. So let's come in here. I redraw our brackets in there. I accidentally deleted those off. So, okay. So we're still just kind of wandering sideways here on the on the Russell. Little old cousin Russell down here. Oh, I wasn't paying attention again. Guys, pay attention. There's another sell signal. So we got our sell signal, or our bear signal indicating the market is coming down. We got our pullback, our little flag formation, a little shelf, and then we should have taken that short position right there at the bottom. Okay, so now you're breaking below a previous low. So this is a previous low. This is, a lot of people will, I don't want to draw a whole line. I'll do this one here. A lot of people will take a short position against this right here. The problem is it's right there at the VWAP. The VWAP can often be considered an area of support. It'll come down and just kind of ride along that area of support and it won't break through. But look up here at the Dow. The Dow came down, gave us that same little pattern right here, and then it broke the VWAP and it's breaking through and going lower. So that could be an indication of what we could expect the Russell to do. But remember, cousin Russell, he likes to do sometimes things a little bit differently than everybody else. So you have to be mindful of that too. That cousin Russell may not break through there like everything else, but oftentimes once we get past the opening bell, cousin Russell, he'll kind of sync up and he'll start working with us. Now here's another little look right there. Another little pattern, another little triangle. See, we have lower lows, lower lows, lower lows. We have lower highs, lower highs, lower highs, lower highs. We got higher lows, lower highs, higher lows, lower highs, and then it broke out to the downside again. So there was another opportunity to get into that trend. And just that little tiny move right there, you could scalp that. That's called scalping if you're just going to take a 1 or 2 bar move. That little bar right there, from there to there on this market was almost $400. That's $400 move. So the market's still very aggressive. This is still a very aggressive market down here. This is a big market. Oftentimes like to work with the smaller market. Oh, and look right there. This thing's breaking down and it's starting to move lower. You'll notice that this move over here, $230 in cousin Russell. He's a little smaller. So generally like to say, well, let's start with a smaller market, build ourselves up a little bit of a cushion, get a little green going in our pocket, and then we can move up to some of the bigger markets. So then you might move up to the S&P or up to the Dow. And then the last one you should really be trading is the NASDAQ once you've got a little cushion. Because if you're wrong on the NASDAQ, just a quick stop on the NASDAQ can be $200 or $300. So you have to be careful on that one. If you build up a $200 or $300 cushion, then you can go over and start trying to trade the NASDAQ and maybe get a little bit bigger position size, make more money. But oftentimes I have a tendency to show off. And so I try to trade the NASDAQ first. And then if you're wrong, then you don't show a big win, you show a big loss, and then that's kind of nasty. You have to go recover from it. So we should probably try to stick with some of these smaller markets first, and then we can go trade the NASDAQ later once we have a little bit of a cushion. All right, so far we've not even taken a trade. I've just been talking too much. Kind of excited to talk to our class and teach you a little bit about what we're doing here and what we're looking for. John's saying there's probably some news. We haven't looked at the news yet either. Some of the news just released, they have caused all the drops. Okay, so let's go look at the news. That's something we haven't done yet. And I usually like to look at that before we get too deep into the market. So here's our economic calendar. And what have we got going? So 8 o'clock, it's 10 after 8 right now. So the 8 o'clock bell, 8:30. 8 o'clock. What time zone are you in, John? So you had, what time zone were you in? Let's see, I got to come back. Can't put that up on that screen. Because for me, my economic calendar is not showing anything at 8 o'clock. We had 7. We had the Fed master speech, and that's not really going to move the market a whole lot, a little bit. He wasn't raising interest rates or anything, but if he's not very confident on the economy, then it draws the market down. We got at 9:30, we got Fed Barkin's speech. So anytime the Fed speaks, it moves the market. It's not a big red one. You'll notice it tomorrow on Friday. Now I'm not going to be doing a live class tomorrow, but I do Monday, Tuesday, Thursday, Wednesday, and Thursday, and I don't do Fridays. Take a day off. So we got 6:30 a.m. We've got some big movers. We got non-farm payroll and unemployment rates coming out at 6:30. But so you can be mindful of that. And if you're watching the futures market at 6:30 in the morning, and then again, that's my time. That's Mountain time. So that's 8:30 Eastern. You can be in front of your computer and watch some big moves in the market, watch the ponies run. So, and then, these that are highlighted in dark, they're 6:30, 6:30, 6:30. And then the ones that are, they're not dark at all. They're not nearly as much. You can come and look at the impact in here and say, I only want to see, I don't need to see the one impact. I only want to see 1 and 2. Or you can say, I don't even want to see, I just want to see 3 impact. There you go. So those are the biggest movers. And so today is a Thursday and we don't have a huge mover in the market. The big movers are the ones that are listed in red, but I like to put the 2s in there. I don't necessarily want to see the 1s. So there we go, 6:37. So the next big one for us is Fed Barker at 9:30. And so that's in not for another little over an hour and 20 minutes away. So what can we do in the meantime? Let's bring that back off the screen. Get back over here. And what's going on now? Oh, look, Cousin Russell never did break down and continue to fall like we were thinking he might do out of that one. He came down, bounced off the VWAP and started to rally. He's just kind of wandering right now. Now, this is another pattern, all right? So this is actually a pattern where we have a strong area of support right here, and the market is trying to rally. So it came back, it tried to rally, tried to go up right here, and failed. Okay, so the first green bars to make a new high, it failed, came down, and now it's trying once again. And if it doesn't break above this, generally speaking, if it doesn't break above this first high, that's what we're looking for, and hold above that line, that's a failure again. So it failed to go up again. So we generally, on that second attempt, see that market go. So that's a double failure. That's not good to see. So we had the first bar come down, start to rally as if we were going to go in an ABC to the upside. So it was A, B, C, anticipate a rise in price. So that failed. So it came down, made another little pullback, tested the area of support, and now it's trying to break above that previous high right now, and it should hold above those yellow dots. All right, it's called a flat top ninja. It's a small one. Oftentimes we like to see that be longer than 3 or 4 bars, but if it holds down here and then breaks above and holds above those yellow dots, that would be an indication that the market is changing to bullish, and it would be an opportunity for you to get into the market to go long up in this region. Now look at what's happening down here on the NASDAQ. There's just an amazing drop in the NASDAQ. We could have, if we would have been paying much attention and trying to trade this a little bit more seriously, there's a lot of money to be made right there in this NASDAQ fall. So you had the ABC pattern. So we actually have multiple drives in here. Remember last night in class, we talked about how oftentimes we'll see 3 drives. So there's drive 1 down to that first green bar. There's drive 2 down to the second green bars. And then there's drive 3 down to the third green bar. So now we're going to say that's the bottom. Doesn't necessarily have to be. Doesn't mean the market can't go down 4 drives, 5 drives, 6 drives down. It certainly can. But these are fractal drives. And overall in the longer term drive, if we turned on the bulls and bears, you'd probably see that that's one big long drive. See that? So that's one big long drive down. But those are fractal drives inside of the bulls and bears. So drive 1, drive 2, drive 3, all as a part of drive 1. So as it comes and it curls around and starts to rally once again, we'll see it probably come and break up a little bit. The question will be, is it going to then come and continue to drive higher? Or is it going to turn, break, and then come back down and start the second drive on the longer term trend? Okay, so we could get a break here, a little rally, and then another continuation of the downtrend. So that's what you have to, that's a decision point. Once again, a decision point is a point where the market could do 2 things. It could either go up based on the pattern, or it could go down based on the pattern. We don't know which one. We have to pick one. We have to pick one of the directions. Now we can change our mind and decide to go one direction. If it doesn't go that way, we can go the other direction. A failed pattern is oftentimes the strongest pattern of all. And so if it fails to the upside, then it usually flushes to the downside, right? So we see that. Okay, here we're getting a rally on the Russell. All right, so we're getting the first break. We want to see it hold above the Russell right here. This is that little pattern. I could show you. We have that pattern right. See if I can find it in my paperwork. Here's the pattern right there. This is what we're seeing in Russell right now. So in Russell, we're seeing this pattern. So we see the down pattern, the down fall. It rallied back up. This is on the bullish side. Rallied back, or came up, came down, try it again, and now it's starting to rally back up out of the top. So we're going to follow along with the market. And look at Russell and the bullish triangle wedge formation that I've got here. Now look at the Russell. That's that exact pattern right there. So you would anticipate if it can hold above that previous green bar, that's the key right there. It's got to hold above that. It's got to close above that previous green bar. If it doesn't, it's going to probably fail and flush out the bottom. Okay, so that would be a failed pattern to the upside. And it looks like we're getting the break, just like we said on the NASDAQ. We just broke the blue lights, and the NASDAQ is falling once again. So there's your signal right there. And it looks like it wants to fall, come back down. We're going to watch it for a second here. Here's another little pattern right here. Just read the charts. Just get used to reading the charts. Get comfortable with reading the charts. And you don't have to jump in with orders all the time. Just try and read the charts. You're getting a little quiet right here, going a little sideways. I'm not real excited about anything. You can see that our CMF indicator is right here at the neutral zone. It's not up in the high region. It's not down in the low region. It's right here in the neutral zone. And when a market's kind of neutral like that, it's kind of a hard time to trade. You don't know what time you're going to get up the breakout. So we're getting a little bit of a shelf right here. It looks like a little bit of a breakout here to the downside on the S&P. It looks like it wants to fall. Doesn't look like it's going to be a strong fall, just because the market's the bars have gone from making nice big beautiful trends to just little itty bitty tiny bars. So the risk is smaller, but you're not taking as big a risk behind your stop, but you're also less likely to get a big move that you're looking for. So this market's still kind of sitting. If you remember, we had our bracket, our high and our low for the 7:30 time frame is just still kind of sitting inside of our channel. It's not really broken out of the channel. We really kind of, the NASDAQ did. The NASDAQ had a nice, good move, beautiful move this morning in the NASDAQ. But now, right now, we're kind of seeing old cousin Russell down here, still stuck in his channel, still stuck dead center of his channel, not really giving us. Cousin Russell oftentimes will be the nice trender. Ask Matt. Matt's made a lot of money trading the Russell. Matt Baker. He's had some good days trading the Russell. So let's watch this. Let's watch this NASDAQ and see if we don't get a rebound and a rally. So see how far that goes. We may get let's bring that full screen so we can see a little bit more of what's going on. So that's a nice, beautiful move in the NASDAQ. Boy, that's a lot of FOMO there. We feel bad we didn't just concentrate and trade that baby. Let's go ahead and let's remove this line. Let's remove this line. Let's remove all these arrows. Actually, probably be easier just to clear all the tools and put our brackets back in than trying to save the brackets. There we go. So there was our morning session bell right there. That was our neutral zone, and it dropped out the neutral zone, made some beautiful moves. That's a big move. Let's draw. So $750 once again. $750, and then we drop that thing. Let's say, let's just go from the red arrow right here, say right in here somewhere, about the VWAP. The VWAP to the bottom of that trend, that was a $2,680 move with a single contract of $750. So you put $750 this when it broke that red line right there, and if you'd have stayed in that entire trend all the way down, using those blue lights as your indication. Let's use the blue lights. Let's say we got in on that right there on the VWAP crossover, and then we got out on the blue lights right here. That was a $2,300 move with a single contract. That was a beautiful move this morning, and it gave us several opportunities to get in. So here was one right here where we got a little pullback shelf. We got another nice move right in here where we got another little shelf, pullback shelf, and we got drive 1, drive 2, drive 3, drive 1, drive 2, drive 3. Now we're getting a retracement. So what do we anticipate in a retracement? So let's come in and look at the retracement. So now what we do is we now measure, okay, we measure with a Fibonacci ruler. So we come in here and we draw from the top of the trend, and you can draw each individual little move like this, drive. You measure drive 1, and then you come down, you measure drive 2, and then you measure drive 3. But then we also, once we get down to the bottom of the third drive, we come down, we measure the entire thing from top to bottom. And then what we'll do is we'll look for the market to come back and rebound. It's broke those blue lights. The question is, how far back against this Fibonacci trend is it going to go? Oftentimes we'll expect it, if it's, traditionally speaking, we would expect it to come back up somewhere into this region here, 38.2. And then if it's going to reverse, we would expect it coming back to 50 to 61.8. And then at that point, the markets oftentimes will kind of die out on us a little bit, and they'll do a little sideways dance like this, and then they'll start to come back down again. So we could see that kind of action going. Or if this thing's still going to have strength to the downside, then we'd watch this to be another start the drive too, right? So this is the A drive is what we call it. This is the B drive. So the next drive would be the B drive down. So this is in the fractal side of things, this would be the A drive. So we had three. This is drive A, drive B, drive C. But then overall in the longer term, because remember, longer and smaller, so that would be drive 1 or drive A and then drive B. Okay. So now we're looking for this market to come in and give us an indication that it's either going to continue to rally higher. So let's get rid of the bulls and bears because it's changing the colors on us. We're going to come in and remove the bulls and bears and just watch the color coding of the Heikin-Ashi bars. All right. And again, we're sitting here watching the NASDAQ as if we're going to trade that one, because I was like, don't trade the NASDAQ first because it's such a big market. You can get your wheels ripped off. Oh, and look, there it goes. Just as I say, let's not trade that one. It's too big. Go trade one of the others. And then there's our signal for a short position right there. So it's dropping out the bottom once again. How far is it going to go? We've got an area of support right here. So it could come down and test that area of support. If it closes below it, we would anticipate it's going to continue down and make that first A drive of the next drive pattern down. But it could also be a rally, right? It's a decision point. So because this market could retrace back up that 50% scale, this could be an opportunity for us to get long. It's not very strong because we want that to pull back a little bit more. Let's wait and see. Come down and stab those yellow dots, but not break through and close below them. So where is it going to close? Is it going to close below those yellow dots? Is it going to close below those yellow dots, or is it going to kind of being a little sideways here? That high peak right up there was a rejection of price going up. So that was bearish. So now the question is it going to break above this high right here and continue to rally? It's going a little slow. And if we think it's going to break above and start to rally, we could put an order in there. And you see, I just click one button and it drops my order right where I want. I've turned that trading over to the computer. It's now going to trade that until we take the long position. But if this closes below those yellow dots, we'll just get rid of it again. Same as last time. So we've tried to take a couple of orders, but none of them have filled in our favor in anticipation of a continuation. This is going to die on us too. We got 12 seconds, and that's going to close below those yellow dots. So we just kill that order and we don't take that long position. That was in anticipation of an A, B, C to the upside, right? So we were looking at this one and saying, well, maybe this market's going to go A, B, C, and I wanted to see it come up like this. And it's failing. Too much downside strength. So now we got the new down arrow. So we had the up arrow. So now we got this little pattern right here with a little flip-flop. See that? So we have an up, down arrow. So now we got that same little pattern right here, up, down arrow. So now we got this area of support right down here. And so the question is it going to break below that area of support, or is it going to come down and use it? And it came right down. See how it came right down? Came right down and touched it. So it came right down, touched it, and bounced right off of it. So that would have to close below it and hold below it, and then we would anticipate a continuation of the downtrend. But oftentimes markets come down and they touch it. That's why if you get in up here a little higher, you anticipate it coming down to that point. You want to take your profits just as it approaches that line. Because if you're taking that short position, oftentimes we want to be trying to take profits right there because it'll come down, bounce, and rally once again. So here we may get a double bottom. That's what we call this one. If it holds that line right there and then turns and starts to rally once again, we would get that A, B, C, and then look for it to rally up off of that one. So you got lower highs, and we could, again, if we wanted to try and anticipate that this market's going to break higher, but this is a decision point because it could turn, obviously, and fall back down and continue lower, and use this as a little shelf as it comes in, and then turn and fall once again. So let's watch and see if we get a green bar. Again, I shouldn't be trading the NASDAQ. We should be overdoing this on the Dow or the Russell or something a little smaller because we haven't made any money yet. And we kind of want to trade this bigger market once we got a little change in our pocket. Okay, there's a clearing bar. So that stabbed those yellow dots. Now it looks like it's turning and wanting to go back up again. So a little bit of indecision. This is the down arrow. So we should be looking for a bearish opportunity. But that's going to switch us again, and now we're going to get an up arrow, and we're going into some chop down here at the bottom. So that shows a choppy market. If we get an up arrow right here, right after an up, a down, an up, now we're getting chop. Doesn't have to move very far in this market to make money. You just have to get a good setup. All right, let's bring this one back down. See what the other markets are doing. They're all making kind of that same little, see, it looks a little bit more bullish over, but see, we're still inside the channel. We haven't even broke out and said we're going to be bullish or bearish on the Dow. The Dow is still inside the morning channel. It's just been kind of wandering, snaking through that morning channel. Okay, we just got that arrow, that little flip-flop again, arrow on the NASDAQ. So that's indecision, where we're getting just a whole bunch of buy-sell arrows in a row like this. This one here is the little flip-flop that's just kind of showing us this little arrow. So you think, well, maybe we'll get another little flip-flop. Then it flopped again. So flip-flop, flip. And now look at it go. Now it's taken to that upside. So it came back, made a double bottom, and it's starting to rally up once again, giving it some strength to the upside. We still haven't taken a trade. That's pretty sad. We haven't taken a trade by now. It's been the first hour, and we've tried to take a couple of shots. There's been a whole bunch of opportunities. I've just been talking and teaching and not trading. Nothing real confident here in Russell. Cousin Russell's just dead over here, Matt. What happened to our cousin Russell? Dow's just a little quiet in here too. NASDAQ's the only one that's really showing some promise in here for us. A little bit disappointed in the Dow and the Russell. S&P kind of wandering a little bit sideways here. I can hear Mark in my head. Why don't you go look at something else, Lan? Go look at crude oil. Go look at the grains. Go look at the metals. Go look at gold and silver. I can hear him in my brain. He lives rent-free in my head. He's my trading buddy. Okay, we're getting a lower high. So we're getting on the NASDAQ. The other markets are dropping. Look, that's a little sell signal right there on cousin Russell. Dropping below, it's getting ready to go to a short side. So that's a little ABC pattern down here on Russell. A, B, C so far. That's looking to try and go short on the Russell. But it's not real confident because it's just not broke below that VWAP yet. It's not gone down there and held. So here's NASDAQ once again, giving us lower highs. So it's giving us a little pennant formation. It's got higher lows and lower highs. If we can get an opportunity to get in on with a low probability entry on this, we got 3 seconds left in the bell, and it's reversing and starting to fall. I was going to try and take a long position off that in anticipation of going long once again, and it's failing to the downside. Not real thrilled about Yeah, it's going to close below. Well, we got 40 seconds. Might just stab it. It's just too weak. Now let's see what it's going to do. We'll give it one more bar and see what that bar is going to do. See if we get a couple of little red bars, and then we can look for, maybe we can get another 3-4 bars up to that 38.2. I want it to decisively move in my favor once I get in. Are we going to take that? We got 7 seconds left. What's it going to do in the next 4, 3, 2, 1? There's our bar. Staying above the yellow lights. It's got to stay above the yellow lights for me. I don't want it to break below the yellow lights and close. That then would turn our arrow to the downside. This is just chop now. It goes up, down, up, down. If it stays down there, then we would anticipate a rally. Stays above those yellow dots. That's just the average true range of 1. It's just an indication that the market is bullish or bearish, and it's sitting there flirting with it right now. And if it closes below it, it's gone back to bearish again. We don't want to take a long position. I'm only going in with a single contract. Come on, baby. Make a decision. 9, 8, 7, 6, 5, 4, 3, 2, 1. Blast off. Here we go. Okay, we're going to go long. Okay, we're long the market. And if it fails on us, we could reverse and say, well, it failed, and we just go short and reverse our position. It needs to decisively move in my favor. So that's the first green candle to make a new high. It needs to go, 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 go. And if it doesn't, if it fails, that's not good. And it doesn't look like it wants to go, 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 go. It's failing on me. And look how much a single contract, and I'm already down $190. So we reversed it and said, all right, if you're going to fail to the upside, then you're probably going to go down. So when it failed to the upside, I reversed it. The problem with this strategy of doing reversal trading is that now it fails to the downside too, and you just sit there and get your hiney handed to you. You're like, well, go reverse it one more time to the upside. If it breaks to the upside. I don't want to do that. Now I'm in recovery mode. Now I'm down. Look at that. I told you, this is the reason why you don't trade these great big markets when they're dead. You need them to go decisively move in your favor. Now we're down $750 on this great big giant market. And we have to go to recovery mode. Now, if it's going to fail once again, we're just going to have to get out and take our lump. After all this, we try to get into one trade and it fails on us, and we take nasty loss. Come on, buddy. Move, move, move. Go in our favor. It's not going to do it. It doesn't like us. Okay, we're going to tell this thing just to trail on the ATR at this point. And if it doesn't go, we're just going to get out and take a loss. We'll be out. We'll be down. Oh, my gosh. We're going to be down a lot of money. $1,400. And now watch it flush to the downside, and it'll probably come flying down there. And if we would have kept our reversal, we'd have made a whole bunch of money and made all our money back. But I hate reversing more than 3 times. That's what you get when you trade this great big giant market. If you're wrong and you reverse a couple of times, it rips your wheels off. Makes you feel bad. I can hear Mark. Why weren't you over doing something smaller? Why weren't you doing a different market? Mark's living rent free in my head. Okay. Well, it's okay. We can do the same thing. We'll pick it back up in the next trade. We'll just wait. We'll wait for the top of the hour, and we'll come back at 9 o'clock or 10 o'clock, and we'll pick up another trend, and I'll be able to recover that if I stick to the NASDAQ. Now, the problem is you jump to the big market like we just did and do as I say, not as I do, and you lose a big chunk of money. So now we're down $1,400 on one simple little trade. We're going to have to stay in the NASDAQ to recover that, because if you go back over to the Russell, now you're going to have to have 3 or 4 or 5 trades to recover that. That's the problem with going backwards, trading the big market instead of the small market. Oh, look at this. Now, of course, it goes in our... This is exactly what just really makes me angry. So we tried to go short, which was the right thing to do, because then it broke long. So we thought, okay, we'll go with the reversal. And then it stopped us out going the other direction. And then we should have stayed into the short side. No way it goes. How much would that have been? Just with a single contract from where it's at right now, that'd have been $750. We had 3 contracts short. We could have been up. We'd have had all our money back. Live and learn. That's the nature of the beast. Try to be cautious. Try to be aggressive. Try to be cautious. The cautious catches you. The aggressive doesn't. Look at that market go now. Now I've got really bad FOMO. I'm feeling really bad. This is the second time I've done that in the last month, where I've put myself into a big hole. What are we down? $1,430. So, oh, that's in the wrong column. You didn't make a $1,400 land. You lost $1,400. So we are down to $232 on the month. We're only up $232 on the month because of that. This is red. So October is back down to $232 for the whole month because of that. Oh, and that's my biggest loser. Biggest day loser. So we have to come in here and tag that thing. Big loser. Look at that. I haven't had a loss like that. I was just... What did we do back in... Come on, Microsoft, give me this. We look at the September 1,000. I had a $1,000 day back there. I haven't had a loss that big in a long time. That was bad, but I'm not worried about it. I will come back at 10 o'clock and we'll get it all back. Just like this was a bad loss too. I think we were down $700, and I came back at 10 o'clock and picked it all back up and was able to put $8 into the account. We'll see. Oh my gosh, look at it go. 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 Now I'm feeling sick again about myself. Oh my gosh, look at it go. It's not even giving us a look back. Let's turn off the Heikin-Ashi for a second, see what it's doing. Oh, look, there was a nice little signal to take a... That was an entry right there on that big push down. Could have jumped in right there too. Oh my gosh, look at it go. I could have been a superhero. But no, not today. Not Batman today. Today I'm the Joker. Mark's texting me. He's going to make fun of me. Watch this. He's texting me. He's over there trading natural gas. Look at this thing go. Look at it go. We were in that thing too, and we got ripped around and went the wrong direction. I should have done one more reversal and we'd have been in this thing. One more and it would have been just fine. But I was trying to be careful, trying to be cautious. All right. Well, we were going to talk about Pit News Magazine for a second. Let's talk about something a little more positive than my trading. So, Pit News Magazine, you guys can get it for $1 for a whole year. Not one issue, 1 year. That's 12 issues for $1. You can listen to the Pit News Magazine. You can read the Pit News Magazine, and there's even videos to watch the Pit News Magazine. And you can come in and you can learn how to do all this kind of trading that I'm doing, and hopefully you can do it better than I just did today. So use LAN Live -$1 to go do that. Go over to pitnews.com. Let me show you Pit News Magazine. We were talking about that here. Let's go over there and I'll show you. This is the this is Pit News Magazine. This is the what issue is this? This is the September issue. And you can see in here we've got the retirement gamble, 62 versus 70, the chalk and money flow, smoke and mirrors. If you're not subscribed, you missed this one. This is the kind of thing you miss. Smoke and mirrors, the illusion of stock buybacks, and embracing imperfection, the art of trading in an ever-changing market. That was a really good article. Really good article. So you see each one's got audio so you can listen to it. Some of them even have video. So for example, if you come down here, this one here, there's a video. So this is one I wrote on the chalk and money flow. So not only can you listen to the article, you can also watch it. You have the PDF, you can download it and take it with you, or you can watch it here in the online, this is called an online document. So this is Smoke and Mirrors, the illusion of buybacks. Let's go look at the October issue. This is the one you would get if you went and subscribed right now. This is David Duty. David Duty comes in here and he is telling you about his ventures into day trading. He's always been a position trader, and so he wanted to tell you what it was like for him to change from position trading to day trading. And so you can listen to his article. He's got a video, shows you how to do it, and then he tells you all the settings that he uses, how he's set this up. He gives you examples of what he does, comes in here with the different markets. He even shows you lots of charts in here, showing you where he gets in, where he gets out, where he sets his filters, everything. And then he tells you all the rules, how the whole thing works right there. And he's shows you, this is a little table showing you, of course, his one day of his trading. And then there's another article in here, Back to the Basics by Aiden Gray, one of our club members. Talks a little bit just about recurring price patterns and talks about trend lines. And then, of course, my book. All of this stuff is in my book as well. So you can get that on Amazon. Trading the Heikin-Ashi trend, color change bars. So this is pretty much what we're doing here. So this is an article, again, that I wrote, another article. You can listen to it, and it talks a little bit about Heikin-Ashi bars and how to trade them, what they are, and some of the patterns. So this is a really good article, a really good magazine. I recommend you swing on over to Pit News Magazine, hit the little subscribe button. When it pops up, it'll ask you for the coupon code, and then hit the little blue button to apply that. And get yourself a copy of Pit News Magazine. All right, guys, I'm feeling really disappointed. Oh, look, we're getting another opportunity to take another short position right here. Let's try it. So this would be a continuation of this downtrend. Let's see if it actually follows through. We come up and then get one more down. We might take another hit on this thing if it just turns and wants to go back up. Now I'm using a stop order, so if it doesn't break lower and start to fall, it doesn't get me in, and there's no cost to that. So see, this is that same little shelf right here. We're seeing it over here on the S&P. We're seeing it over here on each one of these markets is creating that little shelf. So we want to see it stay below the yellow dots, and break lower and make another one of these nice, big, beautiful downtrends. It's 8:45. That's a bad timing. Usually the market's a little bit quiet going into the hour, top of the hour. We'll try one more before we try to get one more trade off before we go call it a day and come back at 10 o'clock and see if we can't make a little bit of a recovery trade. $1,400. I've made that one day. Come on, I can do it, Lan. I have faith in me. I have faith. Come on. Don't break above the yellow dots. $24 seconds. Closes above those yellow dots. So I have to throw it out and wait for another setup. That little thing right there, that's what jacked us up. That little fake and break, just like a good running back. Faked one way and went the other. We went both directions with it. And then I didn't go when it went. I stayed out. Okay, now it should go decisively in our favor. It should just start to truck on down. If it doesn't, I'm not going to reverse. Just going to get out. I tried my reversal and it didn't work for me. Should have gone one more reversal. If we'd have done one more reversal, then we'd be rich, rich, rich beyond our wildest dreams. But no, I got stuck in the mayhem. All right, keep going. Go in our favor. Just keep going. Just keep dropping. I only have one contract. Don't fail on us. Don't fail. Can't have a failure right now. There we go. Okay, I'm not going to let it take any money away from me. So I'm just going to put a stop in here at break even. If it comes back and touches our entry point, I'll just get out because I don't want it to fail on me and go back up. A lot of times that's a bad idea because it'll come up, touch our entry point, and then fall again. But I want it to just decisively move in my favor, and I'm not going to take the chance of losing more money now that I'm already down. I can't afford to do that. I can't take that risk holding my stop back, and it failed on us. So had to get out. I need it to just decisively move in my favor, especially at this point where I've got, I needed a flat top and it rejected that price. Now it's coming down. Watch, I'll do that again. I'm going to get caught not holding my stop too close. But I couldn't take that risk. Couldn't take the risk, not with $1,400 letting that thing turn around and whip me back again. So I had to just get out at break even. Couldn't take the risk. Now look at it dropping again. Oh my goodness. You know how bad I feel right now. Look at that bar. One rejection bar right there. No, it should have been a flat bottom. Why didn't it be a flat top? Why couldn't that bar right there have been a flat top? We'd have still been in this market short. Too smart. Knew that I'm not the only one that put my stop right there. They had to come back and get everybody that did that. Oh my goodness, look at it go. I feel bad. I really feel bad. What a stupid day. 1430 was what did I put in my spreadsheet? Well, now it's 1430. Yeah. Now look at it bounce. Big rejection bar. Like that's a clearing bar right there. Big clearing bar. Like, what's a clearing bar, Lan? Funny you ask. If you go over to the Pit News magazine, go into the October issue, go up to the I think we have clearing bars in here. Is it in this one? Mastering simplicity, trading, navigating market manipulation, understanding clearing bars. There we go. Navigating the market manipulation, understanding clearing bars. You come down here, we talk about clearing bars, and there they all are right there. A whole table of clearing bars and what they all mean. Look at that. There it is, Pit News Magazine. So if you're a trader, this is a great magazine for you. Here, I got to play this. This is my... Not sure if you guys can hear it. I don't know if you guys could hear that. I don't know if it came through to you. That's my my little poem that I put into the Pit News magazine this month. Could you guys hear it? Does somebody tell me in the comments whether you could hear it or not? Kurt's asking about back issues, whether you can get a back issue. We've never done anything about back issues. Somebody wants a back issue, just let me know and we'll figure something out. Get you the back issues. Now look at this market. Oh my goodness, I just feel so sick about that. I could have caught that whole thing down right there. What a mistake. All right, guys, I'm going to put my tail between my legs and see you in class tomorrow night. And I'm going to come back at 10 o'clock and see if I can't recover a little bit of this. I'm not sure if I can get the whole 1,400 back, but we'll see. Hopefully you guys can do better than me. And that's the whole name of the game. I can be your coach. You can be the quarterback. See if you guys can do better than me today. I feel bad. I have to go out with my tail between my legs, but that's the nature of the beast. That's what happens some days. You saw me do it. That's what happens. We will see you live on Monday. For those of you who aren't going to be in class on Friday, for those of you in class, we'll see you Friday. Take care.